please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Manish Sonthalia is with us from Motilal Oswal AMC. Manish, good afternoon. Thanks a lot for taking time out for us. Your thoughts on what's going on right now and what should be the approach of the portfolio investor? Since you run a successful PMS, your thoughts on how to wade through this period?
So, markets have a habit of chasing momentum both on the upside as well as the downside. Nobody talked about excesses getting created in the markets on the upside when the markets were at 11,200 on the Nifty. Similarly, everybody is wanting to chase momentum on the downside. My personal feeling is that you could have some more downside. Clearly, maybe a 5% more downside is possible on the headline numbers. But my sense is there's excesses getting created on the mid-cap and small-cap side in these sort of markets. So, you have seen deep cuts. The silver lining is that the earnings revival is underway. You are seeing multiple compression. But all the negativities in the markets, whether it be the March syndrome or whether it be, let's say, losing of buy polls in some of the states or whether it be raising of interest rates, I mean, to a very large extent, these things have got played out in the mid-cap and the small-cap names. I think people are finding it very complacent to log into large cap names, but I think the risk is clearly on the large caps as opposed to the mid caps and the small caps currently.
That's a really interesting point you're making, Manish, because I mean, obviously there's more there's more a sense of panic and fear around mid caps, particularly on a day like today. So do you get a sense that the worst of this correction is then drawing to a close?
Yeah, I would tend to think so, particularly the mid-cap space where, it's not reflected in the headline corrections which you have seen of something like 10 or 11, 12%. The corrections have been much more. But if you are running a portfolio where you have earnings growth, I mean, a multitude of factors, as I said earlier, the March syndrome and so on and so forth, you are seeing multiple compression. So my sense is the underlying truth in the markets is earnings, and if earnings is underway, you could only compress multiples to a certain point. You can't compress it further. The story is not yet fully played out for the next 2, 3, 4 years as far as the mid-cap and the small-cap names are concerned. So I find it very comfortable at these levels. But one needs to have some patience. You can't be jumping in and around of markets, taking a short-term view. I mean, clearly the markets were quite excessive in the mid-caps when the markets were frothy at 11,000 plus. You had, too much of money that chased mid-caps and small-caps. I mean, those things are coming home to roost. Similarly, now excesses will get built on the mid-cap, small-caps. You'll have many people move out, and markets are going to find an equilibrium and move forward on the higher side.
Okay, minor bit of recovery, just minor, just courtesy Reliance. If you see the intraday chart of Reliance, that's trying to break into the green at this point in time. That one is just about trying to get into the green, so could be interesting. So Manish, again, just to revisit the point, you said another 5% downside is possible on the Nifty, but that would mean bigger damage for the mid caps and small caps. And as you pointed out, last year's perhaps some excesses did get created. So in that sense, do you think this year could be a down year for portfolio investors?
I mean, this calendar year is already a down year. We are underperforming major global markets. So, but I mean, the whole point is, you get to a point where you can't fall any further thanks to earnings revival and multiple, and one more data which I forgot to tell you. If you see past data, if you are seeing an earnings growth cycle kicking in, and you are seeing some moderate increases in rates, I mean, that has worked well for Indian equities as opposed to the fact that, you are going to see increased interest rates and, earnings cycle getting played out. So, in the past, moderate increase in interest rates along with earnings cycle growth has worked positively. So my sense is we are still in, I mean, there's still maybe 9 months to go for, for this year, this calendar year. I would tend to think we'd still have a positive year. Maybe the first half, due to a whole lot of issues, you could see some negativity. But I think once earnings cycle momentum gets reflected fully, you'll start to see that get factored in the markets.
So for this year and in general, what should be the approach for portfolio investors? Get into defensives, avoid high beta?
High beta is always avoidable. The whole point is that, you know, I find comfort in the consumer names, the IT, pharma, agri, cement. These would be some of the names which I think will do well over the next 2-3 years, but you got to wait. It's not that you buy today and you got to start seeing an uptick tomorrow. There's little downside in many of these names which we are seeing currently.
So, since you're saying IT and consumer, if I marry that with the previous answer, Manish, then would it be fair to say that you like perhaps mid-cap IT, let's say, more than large cap? And within consumer, I mean, a lot of stocks are still trading at, you know, 40 times, 45 times plus. So then what within consumer are you comfortable holding?
If you see, in an inflationary environment, it's not the volume growth, it's even the price impact which plays on the top line and the bottom line. People are underestimating the earnings growth on many of the consumer names as we go into the next 1 to 3 years. That's not fully reflected in the valuations, and valuations have also corrected 15-20% in many of these consumer names. These are names which are backed by high free cash flows. These businesses are good businesses. They will tend to have better multiples than the rest of the market. It's a simple truth. In any earning cycle, in any market condition, the consumer names will tend to have a higher P multiple. Now, the acceleration in earnings growth may be, you know, not fully factored in, but that's what I think is going to happen. The large cap IT versus the mid cap IT, I think, you know, it's a case for mid cap IT as opposed to the large cap ITs, clearly because on a YOY basis, sequential basis, the earnings growth would look much better than the large cap IT names. Valuation comfort is there across the board, albeit some excesses in some of the high marquee, highly followed names, but those may be avoidable. But in general, you know, mid cap IT would be favorable to large cap IT.
Okay, that mid cap IT bit has worked for now. PSU banks, Manish, you know, there's some debate on whether there is some value or is this a trap. Your thoughts?
2 years ago, we thought that, you know, things were nearing a bottom, and 2 years down the line, that is currently, we are in a deeper mess. I mean, at least I don't have the capability to see where the mess is going to end. I mean, the bankers themselves are not having a clue as to where this whole situation could end. So if there is no end in sight, then it's no point taking a call on valuation. I've just given it a pass. I wouldn't dare to, you know, call it a deep value or whatever, but, you know, it's just beyond me.
So Manish, as we are winding out, you know, this was a comment that we got from, you know, another market expert we were in conversation with, who said that there is a bit of threat to the HNI money that's coming in, and that could be maybe a market risk if that liquidity starts sort of going away. Do you see that happening in the fund?
Nothing like that. We're still getting net positive inflows, albeit some redemptions due to March or panic or whatever you may call is been seen in the month of March, but net we're still seeing positive inflows in our PMS. So, you know, and if you look at last month's data, you still have 18,000 crores which has come in equity funds, of which 7,000 crores or roughly $1 billion were in SIPs, in mutual funds. If you look at month till date, in the month of March, you have $1 billion of net inflows that have come in through FIs. All of these things look very exaggerated at this given point in time when the markets are, let's say, correcting or looking to correct even further, but these things are looking quite exaggerated. I don't think there is any sort of panic. If people put in money in these sort of times and wait for maybe 1 to 3 years, they'll have a good time.